Britannia's quarterly result commentary strongly attests that companies with agile management and nimble supply chains can outperform in challenging times like today. In our ideas for profit today, I will discuss if this FMCG major should be on investors' radar. Well, the company has had a first mover advantage as it was able to reach the retail store shelves when the others really struggled. Now, this was really backed by a quick ramp up in the production for targeted categories, ably helped by the distribution strategy of the company. Having said that, COVID-19 does have an adverse impact in terms of stalling the new launches, CAPEX plans, and also making it longer to become a total foods company that it has aimed to be. Now let's look at the earnings highlights first. Britannia's Q4 sales and volume growth was broadly flattish, which is noticeable given the significant volume degrowth witnessed so far for the rest of the FMCG sector. Britannia lost nearly 7 to 10% of revenues and net profit due to lockdown in March. Now in the international market, Middle East remained challenging and other markets like Nepal grew in double digits. Having said that, the company witnessed raw material cost inflation of 4% largely due to palm oil and milk, impacting the gross margins which fell 207 basis points year on year. Now, while the employee cost was also high on account of the other lower expenses, EBITDA margins improved. Further, in spite of the surge in interest expense, lower effective tax rate helped net profit increase by 27%. Among the non-biscuit categories, breads had a high single-digit growth with improvement in profitability. Now, in the dairy segment, profitability was maintained sequentially despite the high milk prices. Now, coming to takeaways, what was impressive was the nimbleness shown in managing the supply chain and manufacturing amid the challenges such as the labor shortages. Now, in the recent times, the company has focused on manufacturing 20% of the products, which actually gave them 80% of volumes. Further, the years of efforts towards distribution strategy also came in quite handy for the company. Currently, Britannia has a direct reach of 22.2 lakh outlets and rural dealers reach of 21,000. Now, this helped in reporting revenue growth of 20% and 24% in the months of April and May, respectively. Having said that, the road ahead in terms of gaining further market share is not going to be really easy. Focus is likely to be on cash flow conservation, portfolio rejig, etc. Now, cost-saving measures like the focused ad spend and manpower productivity and also reduction in the fixed cost through renegotiation with the contractors is going to be important. Now, companies' newer categories like wafers, milkshakes, baked salted snacks and even croissants are likely to take longer gestation period now. Now, CAPEX plans are also on hold. Among the risk factors to track are prolonged economic slowdown, which can impact the volume growth. Additionally, higher amount of inter-corporate deposits that were given to the promoter group companies also needs a close watch from here on. Now, in a medium term, we believe Britannia is a good proxy for low-ticket consumption theme and likely to exhibit further market share gains in the uncertain times. However, valuation is rich, that's 52 times FY22 estimated earnings. Further, stock has also sharply jumped by 39% from the levels when we had recommended it as a tactical pick on 27th of March. And hence, we do believe that post the result jump in stock prices definitely provides a decent opportunity to book profits.